In 2024, we've already seen the stock market hit a new all-time high, and my personal dividend portfolio has definitely been reaping the benefits of this. Yet despite the market's really nice performance, there are still opportunities out there. So in this video, we're going to be looking at 5 different dividend stocks that are trading very close to their 52-week low. And 2 of these I actually own in my personal portfolio. To analyze these dividend stocks, we'll be using my spreadsheets powered by Ticker Data, which you can download at the link in the description. So let's go ahead and dive into it. The first company we're going to be looking at trading close to a 52-week low is a massive dividend payer, and that is Altria Group, stock ticker MO, trading at $39.94 per share. Now we can see the 52-week low for this company sitting at about $39.07, so it's pretty close to that range, and the high is around $48 a share. Now over the past year, this company is down around 15.36%. But obviously, if you invest in this company, most of the returns you'll see should come in the form of dividends, and we can see they have a massive starting dividend yield currently sitting at about 9.91%. And here's what's really crazy about this. This company is a dividend king with over 50 consecutive years of dividend increases. So let's go ahead and jump over to my dividend breakdown spreadsheet and look at them from a dividend perspective. I'll go ahead and plug in MO and hit enter. And you can see all this data is going to automatically load in. Now they're currently paying out around $3.92 per share in dividends. So yes, they pay out massive dividends and have a phenomenal dividend history, but the big question with this company that everybody is always wondering about is how safe are those dividend payments moving forward? And that's a very reasonable question to ask. We can see the payout ratio sitting pretty high at around 83.56% and the free cash flow payout ratio sitting at about 74.57%. So those are fairly high payout ratios, and it's a little bit higher than I actually typically like to see, but if you read management's reports, they say that they target a free cash flow payout ratio right at 80%. So this is actually pretty close to where the company is targeting. And if we look at the free cash flow payout ratio chart over time, we can see for the past 4 or 5 years, it looks like their free cash flow payout ratio has been pretty close to that range that management targets. So yes, that free cash flow payout ratio a little bit higher than I typically like to see it, but the dividend is covered by the free cash flow. We can see here on our free cash flow versus dividends paid chart, the free cash flow is growing at a healthy enough rate to sustain that level of dividend growth. And over the past 5 years, the dividend CAGR for this company is sitting at 3.63 and over 10 years about 6.96%. That's honestly pretty unbelievable dividend growth for a company with 50 consecutive years of dividend growth that also has a massive starting dividend yield. But let's go ahead and jump into the valuations for this company. You can see I've already plugged in MO, so this data has loaded in. They have a low beta, so you should see low levels of volatility with this company. Jump into our first valuation, which is going to be Graham's valuation. You could see with our estimated earnings per share, we're actually going to go with what the company has told us. The company said it continues to expect earnings of around $5 to $5.15 per share in 2024. So we will stay on the lower end of that and go with $5.05. We'll apply a growth rate projection of around 3, apply the current yield on AAA corporate bonds, and we come to an intrinsic value of $44.55. Looking at the discounted cash flow analysis, again, you can see we're projecting a free cash flow growth rate of around 2%, and with a discount rate of 9%, we come to an intrinsic value of around $59.24. Typically, the next thing we do is look at the multiples valuation, but I really didn't like it right now in the case of Altria, so we'll skip this and go to our dividend discount model. Basically, what we're doing is we're valuing this company based on how much they pay out in dividends and how much that dividend is increasing over time. So we can see a decent history of dividend growth for this company, and moving forward, I'm projecting a dividend growth rate of 2%, and with a discount rate of 9%, we come to a dividend discount model price per share of $57.12. So when we jump over to the output tab, we can see Graham's at $44.35, DCF at $59.24, and dividend discount model at $57.12. And this gives us an intrinsic value of around $53.57. Looking like Altria is currently undervalued. With a 10% margin of safety, you could see our acceptable buy price at around $48.21, and with a 20% margin of safety, $42.86. Now, one of the things you do have to keep in mind with this company is there is very little growth projected. So of course, those low growth rate projections and the high dividend payout ratios keep a lot of people from investing in this company, but for me, it does look like as of right now, the free cash flow is doing a good job of covering those dividend payments. The second dividend stock close to a 52-week low is none other than Starbucks Corporation, stock ticker SBUX, trading at $91.22 per share. Their 52-week low is around $89.21, and we can see over the past year down around 13.12%, and year to date down almost 5%. Now, if we go ahead and jump over to the dividend metrics for this company, we can see pretty good dividend growth rates overall. We have a 10-year of around 7.56 and a 5-year of around 8.88%. Now, one of the things you'll notice when you look at this yearly dividend chart here It looks like in 2014 they paid out $1.10, but in 2015 they paid out 84 cents. So was there a dividend cut? What exactly happened there? Well, if we dig into this just a little bit more, one of the things that you'll see is if we jump over to the dividend history tab here on Seeking Alpha, scroll out here and we can see the company had a stock split. Oftentimes when you look at quality companies on this chart, it may look like a dividend cut at first, but if you dig deeper into it, you'll notice usually it's the result of a stock split, and that was exactly the case with Starbucks. Now with the cash flow payout ratios, we can see a free cash flow payout ratio of around 66% and a payout ratio of around 59%. So the company does use a lot of its capital to pay out dividends, and it has a decent starting dividend yield currently sitting at about 2.5%. If we go ahead and jump over to the stock valuation spreadsheet, we can see a beta of close to 1, so you should see normal levels of volatility. First valuation we'll look at again is going to be Graham's valuation. You can see our earnings per share projection. Our growth rate projection for Starbucks is quite a bit higher. They have a lot of potential in emerging markets, and then the current yield on AAA corporate bonds. But when we apply all of these, we come to an intrinsic value of $78.64. With our discounted cash flow analysis, again, you can see a higher growth rate projection with the free cash flow, and that leads to a discounted cash flow price per share of $100.69. Now with the multiples valuation, this one's a little bit interesting. We can see the comparable companies we're going with are McDonald's, Yum Brands, Domino's Pizza, and all of these companies have relatively high price to earnings multiple. The average PE multiple is 26.65. We take this number and multiply by Starbucks' earnings per share, and we come to an intrinsic value of $95.94. Now the last valuation we'll look at, again, the dividend discount model, values a company based on how much they pay out in dividends and how much that dividend is increasing over time. If we go with a 6% dividend growth rate and an 8% discount rate, we come to a dividend discount model price per share of $120.84. So when we jump over to the output tab and see all four averaged together, we come to an intrinsic value of $99.03 per share. So with a 10% margin of safety, our acceptable buy price is around $89.12, but it looks like it is still a little bit undervalued according to our intrinsic value. The third dividend stock trading at a 52-week low is one that has been absolutely hammered over the past year, and that is Pfizer, stock ticker PFE, trading at $26.08 per share. Their 52-week low is around $25.61, and over the past year, now down 36.56%, and year-to-date down 9.41%. Now, if we go ahead and jump over to the dividend breakdown for this company, you come up here and plug in PFE and hit enter, and we can see this company has a high starting dividend yield sitting at 6.44%. So obviously that draws the eyes of a lot of dividend investors, but we need to dig into it a little bit more. We can see overall pretty good history of increasing those dividend payouts over time, going from around 96 cents per share to $1.64 in 2023, and the current dividend payout sitting at $1.68. So the 5-year dividend CAGR sitting at 3.4% and the 10-year at 4.91%. Pretty decent dividend metrics for a company with a high starting dividend yield. But here's where things start to get crazy. Look at these payout ratios. They are way out of control. Now, if we look at the free cash flow payout ratio over time, we can see that this hasn't typically been the case for Pfizer for the past decade. We can see for the most part, their free cash flow payout ratio sitting closer to around 50%. And we can see here on our free cash flow versus dividend page chart, for the most part over the past decade, free cash flow has easily covered those dividend payments. And we can see in 2021 and 2022, the free cash flow for the company absolutely exploded because of the vaccines. But in 2023, there was a huge drop off. We can see they generated around $4.8 billion in free cash flow, but the dividends they paid out was over $9 billion. So that is not a good sign. Their free cash flow did not cover their dividends in 2023, and that's why we saw the huge spike up in their free cash flow payout ratio in 2023. So obviously for anyone interested in this company, you need to be checking to seeing if you think this company will be generating enough free cash flow to cover that dividend payment moving forward, because if not, that is not a good sign for the company. But let's go ahead and jump into our valuations. We can see this company has a beta of just 0.56, so you should see very little volatility with the company. If we jump into Graham's valuation, I'll go ahead and zoom in just a little bit more. Again, you can see all of our projections here. We have a low growth rate projection of around 5, and that gives us an intrinsic value of $23.40 per share, a little bit lower than that current trading price. Now, the next valuation we'll look at is the discounted cash flow analysis model. Now, this one's actually a little bit interesting because like we just saw on our dividend breakdown, the company was generating pretty steady free cash flow for quite some time, had a huge spike up in 2021 and 2022, and then a major drop off in 2023. So with free cash flow being that volatile, it's kind of hard to project what the future free cash flow will look like moving forward. But just as an example, if we projected free cash flow of around 6% based off of 2023 numbers, we could see we come to an intrinsic value of around $13.04 per share, but really, I don't think this is the best way to value this company because of the volatile free cash flow we've seen over the past few years. Now again, the next valuation we would typically use is the multiples valuation, but the price to earnings multiple for these comparable companies is absolutely all over the place, again leading me to believe this is not the best valuation for Pfizer as of right now. Now the dividend discount model is one that's a little bit more interesting and reliable, I think, for Pfizer. We can see historical dividend growth rates ranging pretty close to around 2.5 to 2.75%. Moving forward, if we project a dividend growth rate of 2.75% and a discount rate of 8%, we come to a dividend discount model price per share of $32.88. So when we look at our output tab, we can see the three valuations we used, but again, I really don't think a DCF is the best in this scenario, so let's go ahead and remove it. And based on this information, we can see we come to an intrinsic value of $28.14 per share, a little bit higher than that current trading price, but with a 10% margin of safety, acceptable buy price of around $25.32, and with a 20% margin of safety, acceptable buy price of around $22.51. The fourth dividend stock near a 52-week low is a pretty popular one, and that is the Hershey Company, stock ticker HSY, currently trading at $187.56. Now its 52-week low is around $178.82, so it's not quite there, but it is pretty close, and we can see over the past year, down around 21.8%, and year to date, looks like it's traded pretty flat, up around 0.6%. Let's go ahead and jump over to my dividend breakdown tab. We'll come up here and plug in the stock ticker and hit enter. And you can see all of this data is going to automatically load in, and immediately we can see a pretty decent starting dividend yield sitting at about 2.92% and a very nice history of increasing their dividend payouts over time. In 2013 at $1.81, 10 years later, we're sitting at $4.46 per share. So pretty solid dividend growth over the past 10 years. That's a 10-year dividend CAGR of 10.39% and a 5-year of 12.88%. And now we can see their most recent dividend hike put them at $5.48. Now it also looks like the payout ratios are pretty healthy, with the payout ratio sitting at 47.75% and the free cash flow payout ratio at 57.28%. We can also see pretty good free cash flow compounded annual growth rates as well, with the 10-year sitting at 6.36% and the 5-year sitting at 9.59%. So free cash flow payout ratios look pretty solid, sitting pretty close to around 50% for the past few years, and the free cash flow versus dividends paid chart is pretty beautiful. We can see the red charts are showing growing dividends, and they are backed by growing free cash flow as well. So that's really exactly what you want to see out of a dividend growth stock. Let's go ahead and jump over to our valuations. We've already plugged in the stock ticker HSY. We can see a very low beta of 0.34, so you shouldn't see much volatility. If we jump into our first valuation, which is Graham's valuation, you can see after plugging in all our variables, we come to an intrinsic value of around $143.93. If we look at our discounted cash flow analysis, with a free cash flow growth rate of around 8.5%, we come to a discounted cash flow analysis price per share of $184 per share. With our multiples valuation, you can see our comparable companies here, but their average price to earnings sitting at 17.77. Multiply that by Hershey's earnings per share, and we come to an intrinsic value of $161.58. And lastly, looking at our dividend discount model, this is a really interesting one for Hershey's. Assuming just a 6% dividend growth rate, which according to our dividend breakdown tab, it has been very attainable for them over the past decade, we come to an intrinsic value of $290.44, which is way higher than the current trading price. That's a difference of about 54 to 55%. So when we jump over to the output tab and look at all four valuations, we come to an average of around $195 per share. So that's a little bit above the current trading price, but with a 10% margin of safety, we come to an acceptable buy price of around $175.47. And finally, the fifth company we're going to be looking at trading at its 52-week low is British American Tobacco, stock ticker BTI, trading at $29.42 per share, and its 52-week low is around $28.35, so this one is pretty close. And over the past year, they're down around 22.8%, and year to date, this is another company that's traded pretty flat, up around 0.44%. Now let's go ahead and jump over to our dividend breakdown and plug in the stock ticker BTI and hit enter. And you can see all this data is going to automatically load in, and immediately we can see this is one of the highest yielding stocks we've looked at in the entire video, starting dividend yield of about 10.10%. So this is a massive dividend payer. Now, one of the things you'll notice is it says they have a negative payout ratio. What does this mean? Well, if we jump over to Seeking Alpha and look at the income statement here, One of the things you'll notice is BTI, if we scroll down to net income, we can see reported negative earnings in 2023. And basically this was because at the end of 2023, British American Tobacco took a $34.8 billion non-cash impairment charge, and this essentially caused a large non-cash loss on the income statement. Now, if we jump back over to our dividend breakdown again, you can see it looks like they had really big dividend payments and then it got cut. But is that the case? Well, again, if we jump back over to Seeking Alpha, go to dividends and click on dividend history and scroll out, we can see this was not a dividend cut. Again, this was a result of a stock split. But still, here's what's interesting about this. Even after this stock split, we can see the amount the company has paid out in dividends is actually varied by a decent amount. They have some years where it grows and some years where it declines a little bit. So as for me personally, that's not really something I like. I want to see growing dividend payments year after year from the companies that I hold, because keep in mind, anytime a company doesn't have a dividend growth rate above the rate of inflation, that company is technically paying out less in dividends every single year. Now let's go ahead and keep moving forward. We can see free cash flow payout ratio right at around 50%. So that's a very healthy free cash flow payout ratio for a company paying out massive dividend payments. The free cash flow payout ratio chart over time looks pretty decent over the past 5 years. They did have a few years around 10 years ago where it got pretty high, but overall, if we look at free cash flow versus dividends paid out, it looks like the company has done a good job of growing the free cash flow to sustain the dividend payments over time. Now, if we go ahead and jump over to our valuation model, again, very low beta, so you should see very low levels of volatility with this company. If we jump over to Graham's valuation, I'll go ahead and zoom in, and you can see even with low growth rate projections, we come to an intrinsic value of $32.60. With our discounted cash flow analysis, it's the same story. Even with a low free cash flow growth rate projection, we come to a DCF price per share of around $44.19. We're not going to use the multiples valuation in this scenario since there's not a lot of great comparables. But next, if we look at the dividend discount model, again, with a low dividend growth rate of 1% and a discount rate of 9%, we come to a DDM price per share of $37.50. So on the output tab, if we look at all three averaged together, we come to an intrinsic value of $38.10. So with a 10% margin of safety, we get an acceptable buy price of around $34.29, and with a 20% acceptable buy price of $30.48. So it looks like this company is currently a little undervalued. But again, keep in mind, just because a company is undervalued doesn't mean it is a good fit for your portfolio. But there you go, those are 5 dividend stocks that are currently trading very close to a 52-week low. Now, like always, if you'd like to get access to any of my spreadsheets and access to the ticker data function to automatically pull in a stock's financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.